Hi, I'm Matt McKee from S&P Capital IQ, here to talk through our best practice 4-step framework for analysing bank counterparties, which was formed as a result of feedback from our current treasury and risk management clients. The first step in our framework is to assess your company's exposure to banking system risks. Here, it's important to remember that sovereign risk is not the same as banking system risk, so sovereign credit ratings are not a good proxy. Instead, we should use a banking industry country risk score for quick and comprehensive analysis of banking systems on a country-by-country basis. This allows you to be strategic by assessing geographic concentrations in your portfolio and grouping together banking systems with the same level of risk. For example, if we take this illustrative portfolio, the countries at the bottom have low dollar percentage exposures. But by grouping them together, it becomes apparent that 24% of this company's bank portfolio has a bank industry country risk score of BB+ or lower. Step 2 is to analyse the risk of individual counterparties. Here, you should consider taking a complete picture of your credit risk by not only assessing banks that you are exposed to, but also those that you're not exposed to. In this way, treasurers are better placed to anticipate risk and respond quickly to a request for opening a new banking relationship or any unexpected events. Step 3 is to explore trends. It's prudent to perform retrospective trend analysis or forward-looking scenario analysis for individual banks or whole banking systems. Our clients typically ask themselves, is the banking system in an upturn or a downturn? Or how does a particular bank counterparty respond to stress testing? You can use quantitative models to perform this analysis, helping you to determine which of your banks are most resilient and which have the most credit headroom. These first 3 steps provide a medium to long-term view on your counterparty credit risk exposures. If your firm is like any of the more proactive ones we've worked with, you'll want to perform these steps every 6 months to a year. However, the 4th and final step should be performed more frequently. This last step is to monitor your risks by using short-term metrics like credit default swaps, market-derived signals, or short-term probabilities of default. By using these measures, you can utilize the speed of the capital markets to keep your finger on the pulse of risk, rather than rely on metrics based on fundamental data, which only give you a revised view on a quarterly basis. Here we have Cyprus Popular Bank as an example of how our market signal PD could have shown early warning signs of the bank's default starting from early 2012. So how do you monitor your own bank counterparty risk? If you'd like to learn more about how S&P Capital IQ can help you implement this framework, visit www.spcapitaliq-credit.com or contact us via email at emia-marketing@spcapitaliq.com.